Hi, this is James Aim with Full Capital. I'm here with Rowan Burch this morning to talk about a new deal. Rowan, how are you doing? Thanks for joining us while on vacation. So I appreciate it.
Yeah, no, I'm doing well, James. Thanks for having me on. Yeah, happy 4th to everybody and excited to be here.
All right, let's maybe to kick it off, give people a little bit of your background and then a little bit of what you're seeing in today's market.
Yeah. So Rowan Burch, I'm a managing director with RMA, Rowan Multifamily Advisors. I've been in the Dallas multifamily business since 2013, so just under 10 years. In terms of what we're seeing in the market, it's really interesting right now. Cost of capital is obviously going up pretty significantly, and so we've seen a market correction on pricing about 5 to 10%. Each deal is different, and I'd say that as we move forward in this market, things will continue to change. But I mean, we're still seeing deals getting done. We're still seeing a lot of capital coming into the Dallas market specifically because our fundamentals are so strong. So it's definitely a unique time, but I still think that Dallas is in a good position to weather this storm better than other markets.
Absolutely. Well, let's get into this deal. Esperanza, 71 units in Dallas. Let me pull up a map here. So maybe talk about the location of the deal, and then we'll get
Yep.
into some sub-market specifics.
Yeah. So Esperanza is in far north Dallas. It's actually, about 50 yards from being in the city of Richardson. So it's Richardson ISD, city of Dallas. Richardson ISD is definitely a good alternative to the Dallas school system. So it's definitely a positive there. It's located just on the northwest corner of 635 and 75. So you basically got easy access north up 75 or south down to downtown, and then 635 can pretty much get you anywhere in DFW, going east and west. So pretty central, good location, good schools. I grew up about 5 minutes from here actually, so very familiar with the area and the pocket, and I really like this submarket.
All right, so here's some of the other demand drivers. You got UT Dallas, Northview, and then some of the major metros. And then I guess talk about the schools are pretty close. And then I like
Yeah.
the slide that you guys had of sort of your retail. I mean, most class, sort of BC deals don't have like a mixed use component, but I guess talk about the retail that's
Yeah.
sort of walking distance from you.
Yeah. So first off, you mentioned the school. There's an elementary school just to the south of the property in the bottom right-hand corner of this photo here. So it's literally right next door to the property. You got a lot of families on site, so there's a lot of kids that walk to and from school every day. And then in terms of the retail you have nearby, you've got basically three kind of Hispanic markets within walking distance: La Michoacana, Fiesta, and El Rancho. So you're basically walking 2 to 5 minutes to each of those different grocery stores, and so it's a very walkable area. um, I really like the area because you see people walking to and from the school to the supermarkets. There's a walk trail between La Michoacana and the property that goes north and south, so it's just feels like a very walkable area even though it's very suburban.
Yeah, I mean, one of the GPs that I work with, he basically said you want to be within 1 mile. When you're looking at properties, you want to be within 1 mile of at least one freeway, and then you want to be within 1 mile of a grocery store. So I think you've got both of those knocked out with this property. So let's get into the property. Let's talk about sort of what the seller has done to the property and what's left sort of for the buyer to do.
Yeah. So this property was purchased by the current owner a little bit over a year ago. The major thing that they did was it was a central chiller system, and they converted it to an individual HVAC system. So you've got brand new condensers and brand new air handlers in each unit. That was completed about 6 months ago. And they also had to update the breaker panels when they did that. So you got brand new breaker panels in every unit. Bottom right hand corner there, you can kind of see one. So that's the big project that they undertook when they purchased this. And then they've also upgraded interiors as well. So they did about 41 of the interiors with kind of a mid-level package. They did black or stainless appliances. And those stainless are going to be stainless fronted appliances, resurfaced countertops, vinyl plank flooring, two-tone paint, new vanities and mirrors in the bathrooms, new tile tub surrounds, and new plumbing fixtures as well. So that's the extent of their rehab. They did about 41 units to that level. So there's about 30 remaining, about 55% that they've done, 45% remaining.
Okay, I should have brought this slide up earlier. So the
No, you're
rehab
good.
they did. All right, so you had the HVAC conversion from chillers, you had the electrical done, and then I guess some painting work that they did, and then on the interior. So this is really their interior budget for the rehabs, the 550 or so.
Correct.
Okay.
Yes, exactly. And on the left side as well, they did repaint the entire exterior. Also, they updated the office, the leasing office, just kind of modernized it a little bit. And they did do some drainage work with the gutter system as well that helped tie in those drains to spouts that headed out towards the creek or towards the street. So they definitely put a good amount of money into the steel. And I think what's left for the new guys coming in, continuing the interior renovations, and kind of continuing where they left off.
Okay. All right. Anything else on just sort of the overall of the property here that you wanted to mention?
No, so the last thing is they have a lot of kids at the property. And one of the things the manager and the tenants would love to see is like a playground. So there's 2 areas you could do that, some sort of a play place or playground. So I would definitely look into that as a new owner, as you're appealing to a lot of the family renter dynamic and demographic.
And then I guess I think the current owner is local, but how are they managing this property? Because it's 71 units. I'm always interested in sort of how you manage a property this size.
Yeah. So they actually they kind of started their own management group for this property, and so they have 1 staff inside, 1 maintenance outside. So they have full-time 1 in, 1 out. And they're doing a pretty good job with the management here. I mean, obviously, as they did a lot of their rehab, that was all contract work. So maintenance was able to keep up with work orders and the small make readies and turns, just being 1 on site. So they're doing a pretty good job managing this efficiently here.
All right. So let's talk about sort of where rents are today versus where you think you can take them, finishing up these upgrades and sort of with the market.
Yeah. So we essentially took their current asking rents, their current market rents as of today, which they are getting on new leases, and we applied a just under 10%, so about a 9% rent growth over 2 years, and that's how we got to our pro forma rents. So essentially, this submarket's seen about 10 to 12% rent growth over the last 4 quarters. They're projected to see 9 to 10% over the next 2 quarters. So we basically took that and said, hey, we're going to extrapolate this out for 2 years. And we believe that this submarket can definitely garner or hold these rental increases. And another big thing is so many properties on Spring Valley have traded recently that there is a lot of capital being pushed into these deals, and everybody who's putting that capital in is pushing those rents as well. So it's kind of a all boats rise with the tide situation, and this submarket is going to continue to improve.
I don't know if you did that on purpose, but I think Tides bought a property just like a block from here, right? South of here.
That's right. That's right. It was not on purpose, but we'll say it was.
Yeah. So, I mean, let's go back to this chart over here, or this map. I think, along Spring Valley, there are properties similar in size to this, but then south of this property, closer to 635, there are some larger, 200 unit property, 200 plus unit properties that some major owners have come in and bought. And so I think that's sort of what you're mentioning, just in terms of, so this is probably a better map on the bottom here. Talk about some of the comps that you think this one can compare to in terms of age, in terms of location.
Yeah. So, there's a lot of comps you can point to along the street, most of which were built in the 60s and 70s. So you got a lot of comparable properties you can look at. I would definitely focus on some of the properties that have been rehabbed in the last, year to 2 years. So I look at, like Shenandoah, which is a 60s construction property similar to this. They've got a little bit larger unit size. However, it's very similar in terms of the systems that are in place there. They're achieving about $1,300 rents currently. And I know they're continuing to be aggressive on those rental increases. So, it's a flat roof property. But other than that, very similar to Esperanza. So I think that's a really good comp to point to. And then Oaks at Spring Valley, which is closer to 75, not on our comp sheet, but that just traded. That's going to be getting a pretty healthy rehab as well. And then a property just across the street called the Wexler also just traded, and that owner has some pretty ambitious interior renovation program plans there as well. So again, like we mentioned earlier, I think this whole submarket has turned over in the last 4 to 5 years, and a lot of these owners are putting money in, expecting big rental increases. And again, so you're not going to be competing with a property next door that potentially could be undercutting you on pricing. I think all these properties are continuing to be aggressive.
So current market rent's like 1175, and you're thinking take it up to about 1300, sort of in line with the other comps in that submarket. And they're all pretty much the same age. And now with the rehab that the seller's done, you're pretty much comparable, individual HVAC, exterior looks good. Okay.
Yeah.
I got it.
Yeah. You hit it right on the head, James.
Okay. All right. So these are the remaining upgrades to be done, sort of come in, do the interiors. I didn't do the math, but I guess if they did about 40 units already, they spent about 550. So 10, 11 a door on the interiors potentially. So maybe budget out 300,000 to 400,000 for interiors going forward.
Yeah. And I would just say a lot of when they took over, there were some down units and some problem tenants. And so a lot of the turns they did up front were a little heavier than the turns they're having to do now. So I would say maybe it's on the lower end of that number, probably closer to 8,000 a unit. But yes, you're correct. They're spending right at about 10K a unit. Again, they've continued to push those market rents. So on this analysis on the left side, basically we took all the current rents up to those new asking rents, and that's that added value you see at the bottom there at a 5 cap.
Okay. And then it's about, I guess I'm trying to do math, 40, 43, 44 units or 2 3s, 2 or 3 bedrooms, and then 29. Okay. So it's probably a 60-40 mix or so on the 2s and 3s. And you said there's a lot of families at this property already. So, so let's get into sort of where the property is performing today versus sort of where you think you can take it in the pro forma.
Yeah. So this model here reads right to left. So we've got our T12 and kind of coming into the T1, the most recent month of financials on the second column from the left to the left, excuse me. And so they've actually had a pretty big pop in their income in April. We just got May financials in as well. Those are right in line with the April numbers. So we think that T1 is a good number to underwrite to. Going forward, it'll quickly turn into a T3 at that kind of $885,000 rental income number. On the expenses, we used a 70% tax adjustment. We tweaked some minor things on the expense side, but they're really hitting their stride right now. They're continuing to stay about 95 to 98% occupied. Hardly have any vacants for us to show when we're out there. So we think that this property is in a really good position to continue the performance they saw in April. And so that's why we looked at that T1 really when we were pricing this deal.
And so they're rubbing back for utilities across the board. Okay. All right.
They've implemented their RUB system. They're still, I think they just got fully penetrated on that system. So that, 127,000 utility income or utility reimbursement is the good number to use moving forward.
Okay, perfect. All right. So what's good about this is they've sort of stabilized the property, occupancy is good. So, really it's come in, finish up the units on the interiors and bring everyone to market on this deal. Anything you wanted to highlight sort of on a longer term pro forma?
No, I would just say, we pretty aggressive over the first 2 years when a new buyer comes in there, but we used a very kind of standard 3 to 4% market rate rent growth thereafter. And just a big believer in this submarket in this area will continue to get better. It's just a very strong suburban location. So we big believers in that. We think we underwrote that conservatively, if anything.
All right, yeah. So with the occupancy improving, the T1 improving, we looked at a couple ways of financing this deal. And then in terms of whisper price, what's the whisper on this deal?
We're whispering right about 10 million.
10 million. Okay. All right. So yeah, we've looked at it a couple different ways. Fannie and Freddie, they're going to come in and really focus in on that T1 to T3 on net rental. So we're getting in anywhere from 55 to 60%, just depending on what term, what leverage we can get to. Freddie SBL, this is Dallas County, so they're really going to be focused in on hitting a 120 cover. And so you can get higher loan proceeds if you go with like a yield maintenance penalty, or if you want a softer step down, you're going to have a little bit higher interest rate, and a little bit lower proceeds. So just depending on what your business plan is, you could go Fannie Freddie. You're going to be a little bit lower leveraged than if you go bridge. So the non-recourse bridge guys out there, this is a little bit on the smaller side for them. So they're probably going to be around 65% on this deal. And then the recourse bridge, it's sort of a bank loan from local regional bank. They're going to be fixed for about 5 years at 5.5 to 6% on a step down. We've been able to get some lower rates on the fixed rate side from recourse bank lenders. If you're a strong guarantor, if you have sort of multifamily experience, that helps significantly to sort of bring down that interest rate. So really three good options on this deal, whether you go Fannie and Freddie on a non-recourse side, or even recourse bank loan on this particular deal. So I guess I know you guys have been out for a couple of weeks on this deal. Have you set a call for offers date, or are you taking offers as they come? What's the best strategy for buyers?
Yeah. So I would say we are going to be setting a call for offer date here in the next week or so. So be on the lookout for us sending that out. But I would say one of the things we've seen shift in the marketplace is sellers are a little bit more inclined to engage with real buyers that have done their homework earlier on in the process. So I would say if you're interested and would like to submit an offer preemptively, we're not against that. Reach out to myself or anyone on our team, and we can kind of guide you through that process. But I think the biggest thing right now is communicating with us brokers, your interest level, what's going on with your underwriting, who you're using for debt, so we can fully understand that and relay that to our sellers, because sellers are a little bit more inclined to potentially make an early deal now that the market's moved a little bit.
All right. Appreciate you coming on, Rowan, and sort of giving us the story here. And we'll talk to you soon.
All right. Thanks, James.
All right. Thanks.